Welcome to this review of federal mortgage-related laws, key federal laws for mortgage loan originators, brought to you by Birdsey, your AI-powered study partner. In this video, we'll cover RESPA and TILA highlights, ECOA and fair lending requirements, key fraud and compliance protections, and more. Be sure to like and subscribe for more exam prep, and don't miss what's happening in the lower corner. It could be key to passing your exam. Let's begin.
Truth in Lending Act and HOEPA. Disclosure requirements and timing. What is the primary purpose of the Truth in Lending Act? Is it A, to regulate interest rates on loans, B, to ensure consumers are informed about credit terms, C, to provide tax benefits for mortgage interest, or D, to standardize loan application processes? The answer is B, to ensure consumers are informed about credit terms. TILA is designed to promote informed use of consumer credit by requiring disclosures about terms and costs. It aims to protect consumers in credit transactions. Under the Homeownership and Equity Protection Act, when must a lender provide the required disclosures to a borrower? Is it A, at least 3 business days before the loan is finalized, B, at the time of loan application, C, at the closing of the loan, or D, within 30 days after the loan is finalized? The answer is A, at least 3 business days before the loan is finalized. HOEPA requires lenders to provide disclosures at least 3 business days before the loan is finalized to ensure borrowers have time to review terms.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsey.ai for immediate help and a free study session with Birdsey, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
A borrower receives a HOEPA disclosure 3 days before closing. What is the significance of this timing? Is it A, it allows the borrower to cancel the loan without penalty, B, it ensures the borrower receives a lower interest rate, C, it provides the borrower time to review the loan terms, or D, it guarantees loan approval? The answer is C. It provides the borrower time to review the loan terms. The timing ensures the borrower has sufficient time to review the loan terms and make an informed decision before finalizing the loan. Which of the following is a requirement under TILA for adjustable rate mortgages? Is it A, lenders must offer a fixed interest rate option, B, lenders must provide a 30-day cancellation period, C, lenders must cap interest rate increases, or D, lenders must provide a consumer handbook on adjustable rate mortgages? The answer is D. Lenders must provide a consumer handbook on adjustable rate mortgages. TILA requires lenders to provide a consumer handbook on adjustable rate mortgages to ensure borrowers understand the risks and features of these loans. What is a common misconception about the timing of TILA disclosures? Is it A, they must be provided at the time of application, B, they must be provided before closing, C, they are only required for loans over $100,000, or D, they can be waived by the borrower? The answer is B, they must be provided before closing. Why this question may seem a bit tricky. Some may think disclosures are required at application, but TILA mandates they be provided before closing to ensure informed consent. What is the primary purpose of the Truth in Lending Act? Is it A, to ensure consumers are informed about credit terms and costs, B, to regulate interest rates on loans, C, to provide insurance for mortgage loans, or D, to set limits on loan amounts? The answer is A, to ensure consumers are informed about credit terms and costs. TILA is designed to promote informed use of consumer credit by requiring disclosures about terms and costs. Under the Home Ownership and Equity Protection Act, when must a lender provide the required disclosures to a borrower? Is it A, at the time of application, B, at least 3 business days before closing, C, at the time of closing, or D, 1 week after closing? The answer is B, at least 3 business days before closing. HOEPA requires disclosures to be provided at least 3 business days before the loan is finalized. A borrower receives a HOEPA disclosure 3 days before closing. What is the significance of this timing? Is it A, the borrower can cancel the loan within 3 days, B, the borrower must sign immediately, C, the borrower has time to review the terms, or D, the lender can change terms within 3 days? The answer is C, the borrower has time to review the terms. This timing is required by HOEPA to ensure borrowers have sufficient time to understand the loan terms before finalizing. Which of the following is a requirement under TILA for adjustable rate mortgages? Is it A, disclose the initial interest rate only, B, provide a fixed payment schedule, C, guarantee a maximum interest rate, or D, explain how rate changes affect payments? The answer is D, explain how rate changes affect payments. Why this question may seem a bit tricky, TILA requires lenders to provide a clear explanation of how rate changes affect payments, not just disclose the rates. What is a common misconception about the timing of TILA disclosures? Is it A, they are only required at application, B, they are only required at closing, C, they are required at multiple stages, or D, they are optional for lenders? The answer is C, they are required at multiple stages. A common misconception is that TILA disclosures are only required at closing, but they must be provided at various stages. What is the primary purpose of the Truth in Lending Act in terms of consumer protection? Is it A, to ensure consumers are informed about the costs and terms of credit, B, to regulate interest rates on consumer loans, C, to provide financial counseling to consumers, or D, to determine eligibility for credit? The answer is A, to ensure consumers are informed about the costs and terms of credit. The Truth in Lending Act is designed to promote informed use of consumer credit by requiring disclosures about its terms and cost. It aims to protect consumers from unfair credit practices. A lender provides a borrower with a HOEPA disclosure 5 days before closing. What does this timing indicate about compliance? Is it A, the lender is not in compliance with HOEPA timing requirements, B, the lender must provide additional disclosures, C, the lender is in compliance with HOEPA timing requirements, or D, the borrower can waive the disclosure timing requirement? The answer is C, the lender is in compliance with HOEPA timing requirements. HOEPA requires that disclosures be provided at least 3 business days before closing. Providing them 5 days before ensures compliance with this requirement.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsey.
Advertising rules, right of rescission, and HOEPA high-cost provisions. What is the primary purpose of the Truth in Lending Act? Is it A, to ensure consumers are informed about credit terms and costs, B, to regulate interest rates on loans, C, to provide insurance for mortgage loans, or D, to enforce fair housing practices? The answer is A, to ensure consumers are informed about credit terms and costs. TILA is designed to promote informed use of consumer credit by requiring disclosures about terms and costs. It helps consumers compare credit offers. Under the right of rescission, how many days does a borrower have to cancel a qualifying loan transaction? Is it A, 1 day, B, 3 days, C, 5 days, or D, 7 days? The answer is B, 3 days. The right of rescission allows borrowers 3 business days to cancel certain loan transactions, providing a cooling-off period. A lender advertises a mortgage with a low interest rate but fails to disclose that it is only available for the first year. What TILA requirement is the lender violating? Is it A, right of rescission, B, HOEPA, high-cost provisions, C, advertising disclosure requirements, or D, APR calculation? The answer is C, advertising disclosure requirements. TILA requires that all terms of a loan, including any temporary rates, be clearly disclosed in advertisements to prevent misleading consumers. Which of the following loans is most likely to be covered under HOEPA high-cost provisions? Is it A, a standard 30-year fixed mortgage, B, a government-backed FHA loan, C, a conventional loan with a low APR, or D, a loan with high fees and interest rates? The answer is D, a loan with high fees and interest rates. Why this question may seem a bit tricky. HOEPA applies to high-cost loans, often identified by high interest rates or fees. It can be easy to confuse with other loan types. What must lenders provide to borrowers under the TILA right of rescission? Is it A, a copy of the loan agreement, B, a list of alternative lenders, C, 2 copies of a notice of the right to rescind, or D, a waiver of the right to rescind? The answer is C, 2 copies of a notice of the right to rescind. Lenders must provide borrowers with 2 copies of a notice explaining their right to rescind, ensuring they are informed of this option. What is the primary purpose of the Home Ownership and Equity Protection Act? Is it A, to regulate interest rates on all mortgages, B, to protect consumers from predatory lending practices, C, to provide tax benefits for homeowners, or D, to standardize mortgage application processes? The answer is B, to protect consumers from predatory lending practices. ECOA is designed to protect consumers from predatory lending practices by imposing additional disclosure requirements and restrictions on certain high-cost loans. A borrower takes out a home equity loan and receives the necessary disclosures. How many days do they have to rescind the transaction under TILA? Is it A, 1 day, B, 2 days, C, 3 days, or D, 5 days? The answer is C, 3 days. The Truth in Lending Act provides borrowers with a 3-day right of rescission period after receiving the necessary disclosures for certain loans. Which of the following features would most likely trigger HOEPA high-cost loan provisions? Is it A, a fixed interest rate, B, a low down payment, C, a long loan term, or D, excessive fees and high interest rates? The answer is D, excessive fees and high interest rates. Why this question may seem a bit tricky. HOEPA provisions are triggered by specific criteria, such as high interest rates or excessive fees, not just any loan feature. Real Estate Settlement Procedures Act. Disclosures, loan estimate, closing disclosure. What is the primary purpose of the loan estimate under RESPA? Is it A, to provide borrowers with a summary of loan terms and costs, B, to finalize the loan agreement between lender and borrower, C, to serve as a binding contract for the loan, or D, to replace the closing disclosure? The answer is A, to provide borrowers with a summary of loan terms and costs. The loan estimate is designed to provide borrowers with a clear and concise summary of the key terms and costs of a mortgage loan, helping them compare offers. When must a lender provide the loan estimate to a borrower? Is it A, within 1 business day of application, B, within 3 business days of application, C, at the time of closing, or D, after the loan is approved? The answer is B, within 3 business days of application. The loan estimate must be provided within 3 business days of receiving a loan application to ensure timely disclosure of loan terms. A borrower receives a loan estimate and notices a significant change in the loan terms on the closing disclosure. What should the borrower do? Is it A, ignore the changes and proceed with closing, B, immediately cancel the loan application, C, review the documents and discuss discrepancies with the lender, or D, assume the changes are minor and proceed? The answer is C, review the documents and discuss discrepancies with the lender. The borrower should compare the loan estimate and closing disclosure to understand discrepancies and discuss any concerns with the lender before proceeding. Which document is used to confirm the final terms and costs of a mortgage loan? Is it A, loan estimate, B, good faith estimate, C, pre-approval letter, or D, closing disclosure? The answer is D, closing disclosure. Why this question may seem a bit tricky. The loan estimate and closing disclosure both provide cost information, but only the closing disclosure confirms final terms. What information is not included in the loan estimate? Is it A, loan terms, B, borrower's credit score, C, projected payments, or D, closing costs? The answer is B, borrower's credit score. The loan estimate includes loan terms, projected payments, and closing costs, but not the borrower's credit score. What is the maximum number of business days a lender has to provide a loan estimate after receiving a loan application? Is it A, 1 business day, B, 3 business days, C, 5 business days, or D, 7 business days? The answer is B, 3 business days. Under RESPA, lenders must provide the loan estimate within 3 business days after receiving a loan application. Which section of the closing disclosure provides details about the loan terms? Is it A, loan terms, B, projected payments, C, closing costs, or D, loan calculations? The answer is A, loan terms. The first section of the closing disclosure outlines the loan terms, including the loan amount, interest rate, and monthly principal and interest. A borrower receives a loan estimate with an interest rate of 4.5%. At closing, the rate is 5%. What should the borrower verify on the closing disclosure? Is it A, the loan amount, B, the loan term, C, the interest rate, or D, the closing costs? The answer is C, the interest rate. The borrower should verify the interest rate on the closing disclosure to ensure it matches the agreed terms or understand why it changed. What is the purpose of the closing disclosure under RESPA? Is it A, to estimate closing costs, B, to apply for a loan, C, to negotiate loan terms, or D, to confirm final loan terms and costs? The answer is D, to confirm final loan terms and costs. The closing disclosure provides the final details about the mortgage loan, including loan terms, projected monthly payments, and fees. Which of the following is a requirement for the loan estimate under RESPA? Is it A, It must be provided within 1 business day. B. It must include the final closing costs. C. It must be provided within 3 business days. Or D. It must be signed by the borrower. The answer is C. It must be provided within 3 business days. Why this question may seem a bit tricky. The loan estimate must be provided within 3 business days, but it must also be accurate and reflect the terms of a loan.
Stuck on a question? Just think of the Birdsey link in the description as your friendly neighborhood superhero swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Prohibited practices, kickbacks, referrals, escrow limits. Under RESPA, what is the maximum amount a lender can require a borrower to keep in an escrow account for property taxes and insurance? Is it A, 2 months' worth of payments? B, 3 months' worth of payments? C, 4 months' worth of payments? Or D, 6 months' worth of payments? The answer is A, 2 months' worth of payments. RESPA limits the amount a lender can require in an escrow account to no more than 2 months' worth of payments for taxes and insurance. Which of the following practices is prohibited under RESPA? Is it A, providing a discount for early payment? B, paying kickbacks for referrals? C, charging a late fee? Or D, offering a loyalty program? The answer is B, paying kickbacks for referrals. RESPA prohibits the payment of kickbacks and unearned fees in real estate transactions. What is the purpose of RESPA's prohibition on kickbacks and referral fees? Is it A, to increase lender profits? B, to simplify the mortgage process? C, to protect consumers from unnecessary costs? Or D, to regulate interest rates? The answer is C, to protect consumers from unnecessary costs. RESPA aims to protect consumers by ensuring they are not charged for services they did not receive and to prevent unnecessary increases in the cost of settlement services. A real estate agent refers a client to a mortgage broker and receives a $500 gift card as a thank you. Is this allowed under RESPA? Is it A, yes, because it's a gift, not cash? B, yes, if disclosed to the client? C, no, unless the client agrees? Or D, no, this is a prohibited kickback? The answer is D, no, this is a prohibited kickback. RESPA prohibits any form of kickbacks or referral fees, including gifts, for referring business related to a real estate settlement service. Can a title company offer a discount on its services to a real estate agent for referring clients under RESPA? Is it A, yes, if the discount is less than 10%? B, no, this is considered a kickback? C, yes, if disclosed to the client? Or D, no, unless the agent is also a client? The answer is B, no, this is considered a kickback. Why this question may seem a bit tricky. Discounts might seem permissible, but RESPA prohibits any form of compensation for referrals, including discounts, as they can be considered kickbacks. Under RESPA, what is the maximum cushion a lender can require in an escrow account for property taxes and insurance? Is it A, 1 month? B, 2 months? C, 3 months? Or D, 4 months? The answer is B, 2 months. RESPA allows lenders to require a cushion of up to 2 months of escrow payments to cover potential shortages. This helps ensure that there are sufficient funds to cover taxes and insurance when they are due. A mortgage broker offers a real estate agent a percentage of their commission for every client referred. Is this practice allowed under RESPA? Is it A, yes, if disclosed to the client? B, yes, if the client agrees? C, no, this is a violation of RESPA? Or D, No, unless the broker is licensed. The answer is C. No, this is a violation of RESPA. RESPA prohibits kickbacks and referral fees in exchange for business referrals in real estate transactions. This practice would be considered a violation of RESPA. Can a lender legally require a borrower to use a specific title insurance company under RESPA? Is it A? No, this is prohibited under RESPA. B. Yes, if the lender discloses the relationship. C. Yes, if the borrower agrees in writing. Or D. No, unless the borrower requests it. The answer is A. No, this is prohibited under RESPA. Why this question may seem a bit tricky, RESPA prohibits lenders from requiring borrowers to use a specific title insurance company as a condition of the loan, which might be confused with permissible lender recommendations. Equal Credit Opportunity Act and Fair Housing. Protected classes and non-discrimination rules. Under the Equal Credit Opportunity Act, which of the following is considered a protected class? Is it A. Employment status, B. Marital status, C. Credit score, or D. Education level? The answer is B. Marital status. ECOA prohibits discrimination based on race, color, religion, national origin, sex, marital status, age, or because an applicant receives public assistance. Which federal law prohibits discrimination in housing based on race, color, religion, sex, or national origin? Is it A. Fair Housing Act, B. Truth in Lending Act, C. Home Mortgage Disclosure Act, or D. Real Estate Settlement Procedures Act? The answer is A. Fair Housing Act. The Fair Housing Act prohibits discrimination in housing-related activities based on race, color, religion, sex, national origin, disability, and familial status. What is the primary purpose of the Equal Credit Opportunity Act? Is it A. To regulate interest rates, B. To control credit card fees, C. To prevent discrimination in credit transactions, or D. To standardize loan application forms? The answer is C. To prevent discrimination in credit transactions. The ECOA aims to ensure that all consumers are given an equal chance to obtain credit without discrimination. A lender denies a loan application because the applicant is receiving public assistance. What law does this action potentially violate? Is it A. Fair Housing Act, B. Truth in Lending Act, C. Home Mortgage Disclosure Act, or D. Equal Credit Opportunity Act? The answer is D. Equal Credit Opportunity Act. ECA prohibits discrimination based on the fact that an applicant receives public assistance, ensuring fair access to credit. Which of the following is not a protected class under the Fair Housing Act? Is it A. Race, B. Religion, C. Marital status, or D. National origin? The answer is C. Marital status. Why this question may seem a bit tricky, the Fair Housing Act includes familial status, which might be confused with marital status. Marital status is not covered under the Fair Housing Act, but is under ECOA. Under the Equal Credit Opportunity Act, which of the following factors cannot be used to discriminate against a loan applicant? Is it A. Credit history, B. Marital status, C. Employment status, or D. Loan amount? The answer is B. Marital status. The ECOA prohibits discrimination based on race, color, religion, national origin, sex, marital status, age, or because an applicant receives public assistance. A landlord refuses to rent an apartment to a family because they have children. Which law does this action potentially violate? Is it A. Equal Credit Opportunity Act, B. Civil Rights Act of 1964, C. Fair Housing Act, or D. Americans with Disabilities Act? The answer is C. Fair Housing Act. The Fair Housing Act prohibits discrimination based on familial status, which includes families with children under 18. Which of the following is a protected class under the Fair Housing Act, but not explicitly under the ECOA? Is it A. Race, B. Sex, C. National origin, or D. Familial status? The answer is D. Familial status. Why this question may seem a bit tricky. The Fair Housing Act includes familial status as a protected class, which is not explicitly covered under the ECOA. Notification of adverse action. Under the Equal Credit Opportunity Act, which of the following is a prohibited basis for denying credit? Is it A. Credit score, B. Marital status, C. Employment history, or D. Debt-to-income ratio? The answer is B. Marital status. ECOA prohibits credit discrimination based on race, color, religion, national origin, sex, marital status, age, or because someone receives public assistance. What is the required time frame for a creditor to notify an applicant of an adverse action under ECOA? Is it A. 10 days, B. 15 days, C. 30 days, or D. 45 days? The answer is C. 30 days. Creditors must notify applicants of an adverse action within 30 days of receiving a completed application. Which of the following must be included in an adverse action notice according to ECOA? Is it A. Specific reasons for the denial, B. The applicant's credit score, C. The creditor's profit margin, or D. The applicant's employment history? The answer is A. Specific reasons for the denial. An adverse action notice must include the specific reasons for the denial or a statement that the applicant can request the reasons. A lender denies a loan application due to insufficient income. What must the lender do to comply with ECOA? Is it A. Notify the applicant verbally, B. Send an adverse action notice with specific reasons, C. Offer a different loan product, or D. Request additional documentation? The answer is B. Send an adverse action notice with specific reasons. The lender must provide an adverse action notice with specific reasons for the denial, such as insufficient income. If a creditor takes an adverse action based on information from a credit report, what additional step must they take under ECOA? Is it A. Notify the applicant within 10 days, B. Provide a copy of the credit report, C. Offer a chance to reapply, or D. Include the credit reporting agency's contact information? The answer is D. Include the credit reporting agency's contact information. Why this question may seem a bit tricky. It involves both ECOA and FCRA. The creditor must provide the applicant with the credit reporting agency's contact information. Under the Equal Credit Opportunity Act, what must a creditor provide if they deny a credit application based on the applicant's creditworthiness? Is it A. A copy of the applicant's credit report, B. A specific reason for the denial or the right to request it, C. A list of all creditors who have denied the applicant, or D. A summary of the applicant's credit score? The answer is B. A specific reason for the denial or the right to request it. ECOA requires creditors to provide a specific reason for denial or inform the applicant of their right to request this information within 60 days. When a creditor takes an adverse action based on information not obtained from a credit report, what must they include in the notice under ECOA? Is it A. The applicant's credit score, B. A copy of the credit report, C. Specific reasons for the adverse action, or D. The name of the credit reporting agency? The answer is C. Specific reasons for the adverse action. Why this question may seem a bit tricky. It tests knowledge of ECOA requirements beyond credit reports. Creditors must provide the specific reasons for adverse action, even if not based on a credit report. Other consumer protection laws. Fair Credit Reporting Act and FACTA. What is the primary purpose of the Fair Credit Reporting Act? Is it A, to ensure accuracy and privacy of consumer credit information? B, to regulate interest rates on consumer loans? C, to provide free credit reports annually? Or D, to prevent identity theft? The answer is A, to ensure accuracy and privacy of consumer credit information. The FCRA aims to ensure accuracy, fairness, and privacy of personal information in the files of consumer reporting agencies. Under the FCRA, how often can consumers request a free credit report from each of the major credit reporting agencies? Is it A, every 6 months? B, every 3 months? C, once every 12 months? Or D, twice a year? The answer is C, once every 12 months. Consumers can request a free credit report once every 12 months from each major credit reporting agency. John notices an error on his credit report. What is his first step under the FCRA to address this issue? Is it A, contact the creditor directly? B, dispute the error with the credit reporting agency? C, file a complaint with the FTC? Or D, wait for the error to correct itself? The answer is B, dispute the error with the credit reporting agency. John should first contact the credit reporting agency to dispute the error, as they are responsible for investigating disputes. Which law requires lenders to provide consumers with a free credit score disclosure? Is it A, Truth in Lending Act? B, Equal Credit Opportunity Act? C, Fair Debt Collection Practices Act? Or D, Fair and Accurate Credit Transactions Act? The answer is D, Fair and Accurate Credit Transactions Act. FACTA requires lenders to provide a free credit score disclosure when a consumer applies for a mortgage. What is a key difference between the FCRA and FACTA? Is it A, FCRA deals with identity theft protection? B, FACTA includes provisions for free credit reports? C, FCRA requires lenders to provide credit score disclosures? Or D, FACTA regulates the accuracy of credit information? The answer is B, FACTA includes provisions for free credit reports. Why this question may seem a bit tricky. Both laws deal with credit information, but FACTA specifically includes provisions for free credit reports and identity theft protection. What is the primary purpose of the Fair and Accurate Credit Transactions Act? Is it A, to regulate interest rates on credit cards? B, to improve consumer access to credit information? C, to establish a national credit score system? Or D, to eliminate all credit reporting agencies? The answer is B, to improve consumer access to credit information. FACTA was enacted to enhance consumer protections in credit reporting, including provisions for identity theft prevention and the right to access free annual credit reports. Sarah receives a notice that her credit report was accessed without her consent. Under the FCRA, what can she do to address this issue? Is it A, request a copy of her credit report and dispute unauthorized inquiries? B, file a lawsuit against the credit reporting agency? C, contact the Federal Trade Commission directly? Or D, ignore the notice as it has no legal implications? The answer is A, request a copy of her credit report and dispute unauthorized inquiries. Sarah can request a copy of her credit report to review any unauthorized inquiries and dispute them with the credit reporting agency.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsey.
Gramm-Leach-Bliley Act and Privacy Rules. What is the primary purpose of the Gramm-Leach-Bliley Act? Is it A, to protect consumers' personal financial information, B, to regulate interest rates on loans, C, to oversee stock market transactions, or D, to manage federal tax policies? The answer is A, to protect consumers' personal financial information. The GLBA aims to protect consumers' personal financial information held by financial institutions. It mandates privacy notices and safeguards to ensure data security. Which of the following is a requirement under the GLBA for financial institutions? Is it A, to offer free credit reports annually, B, to ensure all deposits up to $250,000, C, to provide privacy notices to customers, or D, to report all transactions over $10,000? The answer is C, to provide privacy notices to customers. Financial institutions must provide privacy notices to customers explaining how their information is collected and shared. Under the GLBA, what must financial institutions do to protect customer information? Is it A, share information with third parties, B, implement security measures, C, provide free financial advice, or D, offer low-interest loans? The answer is B, implement security measures. The GLBA requires financial institutions to implement security measures to protect customer information from unauthorized access. A customer receives a privacy notice from their bank explaining how their data is shared. What GLBA requirement does this fulfill? Is it A, data breach notification, B, opt-out provision, C, information security program, or D, privacy notice requirement? The answer is D, privacy notice requirement. The GLBA requires financial institutions to provide privacy notices to customers detailing how their information is used and shared. Which of the following is not a component of the GLBA's privacy rule? Is it A, privacy notices, B, mandatory arbitration clauses, C, opt-out rights, or D, safeguarding rules? The answer is B, mandatory arbitration clauses. Why this question may seem a bit tricky. The GLBA's privacy rule includes privacy notices, opt-out rights, and safeguarding rules, but not mandatory arbitration clauses. Home Mortgage Disclosure Act reporting. What is the primary purpose of the Home Mortgage Disclosure Act? Is it A, to provide public information on how financial institutions serve housing needs, B, to regulate interest rates on home mortgages, C, to enforce fair housing laws, or D, to provide tax benefits for home buyers? The answer is A, to provide public information on how financial institutions serve housing needs. The HMDA aims to provide the public with information about how financial institutions are serving the housing needs of their communities. Which type of data must financial institutions report under HMDA? Is it A, employees' salary data, B, loan data including borrower demographics, C, marketing expenses, or D, branch locations? The answer is B, loan data including borrower demographics. HMDA requires reporting of loan data, including loan amount, type, and borrower demographics. Who is responsible for enforcing the Home Mortgage Disclosure Act? Is it A, Federal Reserve, B, Department of Housing and Urban Development. C. Consumer Financial Protection Bureau. Or D. Federal Deposit Insurance Corporation. The answer is C. Consumer Financial Protection Bureau. The Consumer Financial Protection Bureau is the primary enforcer of HMDA regulations. A bank has just completed its annual HMDA data collection. What is the next step they must take to comply with HMDA regulations? Is it A. Analyze the data for internal use? B. Publish the data on their website? C. Destroy the data after review? Or D. Submit the data to the regulatory agency? The answer is D. Submit the data to the regulatory agency. After collecting data, banks must submit it to the appropriate regulatory agency, typically the CFPB, by March 1st of the following year. Which of the following is not a requirement under HMDA reporting? Is it A. Loan amount? B. Borrower's credit score? C. Loan purpose? Or D. Property location? The answer is B. Borrower's credit score. Why this question may seem a bit tricky, HMDA requires detailed loan data, but not the reporting of the borrower's credit score. SAFE Act provisions for MLOs. What is the primary purpose of the SAFE Act for mortgage loan originators? Is it A. To establish minimum standards for licensing and registration of MLOs? B. To regulate interest rates on mortgage loans? C. To provide financial assistance to homebuyers? Or D. To oversee real estate appraisals? The answer is A. To establish minimum standards for licensing and registration of MLOs. The SAFE Act aims to enhance consumer protection and reduce fraud by establishing minimum standards for the licensing and registration of MLOs. Which entity is responsible for maintaining the nationwide multi-state licensing system and registry? Is it A. Federal Reserve? B. Consumer Financial Protection Bureau? C. Conference of State Bank Supervisors? Or D. Department of Housing and Urban Development? The answer is C. Conference of State Bank Supervisors. The Conference of State Bank Supervisors and the American Association of Residential Mortgage Regulators maintain the NMLS. What is a key requirement for an individual to obtain an MLO license under the SAFE Act? Is it A. Complete a 40-hour training course? B. Pass a written test on mortgage laws? C. Have at least 5 years of experience in mortgage lending? Or D. Submit a personal financial statement? The answer is B. Pass a written test on mortgage laws. An individual must pass a written test covering federal and state mortgage laws and regulations to obtain an MLO license. A mortgage loan originator is reviewing their continuing education requirements. What is the minimum number of hours they must complete annually under the SAFE Act? Is it A. 8 hours? B. 12 hours? C. 15 hours? Or D. 20 hours? The answer is A. 8 hours. MLOs must complete at least 8 hours of continuing education annually to maintain their license under the SAFE Act. Under the SAFE Act, which of the following is not a requirement for an MLO license renewal? Is it A. Completion of continuing education? B. Background check? C. Payment of renewal fees? Or D. Submission of a new credit report? The answer is D. Submission of a new credit report. Why this question may seem a bit tricky. The SAFE Act requires continuing education and background checks, but not a new credit report for renewal.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit birdsey.ai for complimentary study sessions with Birdsey, your AI-powered study partner.